Our last student here from the University of Connecticut.
Hello, I'm Alexander Bellofiore. I'm a junior year undergrad representing UConn. UConn has two equity programs. The Opportunity Fund Project is a small cap focused $225,000 portfolio, and the Student Managed Fund is a $1.2 million large cap portfolio. The company I'm presenting is a small cap whiskey company, MGP Ingredients, ticker MGPI. It trades around $18 a share right now, 380 million market cap, roughly 85% below all-time highs. What they do, they're a whiskey company that sells whiskey to other whiskey companies. They also provide complimentary warehousing services to the companies as the barrels age. They generate revenue from that. The value proposition is you outsource the capital intensity of distilling and focus on what you're good at, the branding and selling the whiskey. They also sell whiskey in-house under their own portfolio of brands. Here they capture the markup and pricing power that comes from strong branding. And then finally, the ingredient solutions segment provides uncorrelated profits to the alcohol industry. They sell specialty wheat and protein starches to food companies. These are crucial product formulations and achieving specific clean label claims. So the whiskey industry had a boom and then overproduced on inventory. Now everyone's cutting back and right-sizing that inventory. So that's the core reason why the stock has done so poorly. Sales in the distilling segment fell 52%, gross margin compressed, and gross profit also fell 52%. Importantly, the warehousing component of that business offers a high $32 million high margin floor. That only fell down 3%. 2026 is expected to be the bottoming of that cycle. The industry cut down on production by 30% in 2025, and that's continuing into 2026. When inventory normalizes, this segment acts as a coiled spring to the upside. So this is really the first time in the history of the company that the management is really oriented towards the branded spirits business. They brought in a new CEO, Julie Francis. She has experience from Coca-Cola and Constellation Brands. Martin Roper, he's the new chairman. He's the 17-year former CEO of the Boston Beer Company, where he scaled Samuel Adams. And then they also poached the chief marketing officer of Brown-Forman to become their own officer. This gives me the indication of a harder pivot toward the branded side. The growth engine on the branded side is Penelope Bourbon. That's a company that used to be a former customer of theirs. They vertically integrated them. Penelope grew 80% year over year in 2025. Importantly, this is very healthy growth. They doubled the points of distribution while also increasing velocity by 12%. That means even as they enter these tier 2, tier 3 locations where their brand is less known, products are still moving off the shelf quicker. As the mix shifts towards premium spirits through Penelope, the margin naturally expands. To accelerate this shift, management is rationalizing the 20% of the tail brands in the portfolio. So the big fear around the industry is that consumption is structurally declining. I'm of the belief that this is more of a behavioral cycle among humans. Also, whiskey is inherently better positioned to other alcoholic beverages. They have an older demographic age base of really older millennials and Gen X. These people are much more resilient in their consumption of alcohol and also of higher discretionary income. So the company has a very healthy balance sheet to support their debt. They're going to spike to 3.7 times net debt to EBITDA next year when they pay out an earnout for the Penelope acquisition. They've already secured the financing in a $500 million revolving credit facility. Very importantly, they have $301 million in aged whiskey reserves at cost on the balance sheet that'll provide working capital flexibility. And also, CapEx is coming down towards maintenance levels because they no longer have to expand their capacity. So there's really two ways to get a return on this investment. One, if the market gives them partial credit for the branded side of the business and they re-rate to industry peers. The industry trades at 11 times EV/EBITDA. MGP trades at 5.8 times. Aged spirits like Brown-Forman and Remy Cointreau are given even greater premiums to the peer group. They can also, the catalyst for that would be the continued shift towards branded, as well as the visible margin expansion coming through. They can also re-rate to the industry, or if the industry could re-rate as a whole. Historically, averages flowed between 16 times and 22 times EBITDA. If fears about alcohol consumption alleviate, then the industry re-rates with MGP. The distressed valuation protects the downside in this investment. They trade 0.5 times below book value. When you take out intangible assets and just look at tangible book value, they trade at an 8% premium to that. That effectively means the market gives zero valuation to the brands that they have. We know these brands are worth something because Penelope is still growing 80% through a down market. When you're buying this company, one, you're buying a cyclical segment entering a bottoming year that can act as a coiled spring once these inventory levels normalize. And you're also buying a great margin and multiple expansion story as the company transitions into a more specialized business. So I'm projecting around 20% annualized return through 2030. Thank you.
Thank you, Alex, for that presentation. I guess I want to dig in a little bit on the re-rating factor and this demographic. You know, that shift, I know you give good reasons, and I like to feel like maybe I'm one of those resilient people that still can handle my alcohol, questionable. But anyway, kidding aside, you know, what if this really is a deeper shift, you know, generational, demographic? You know, how are you confident that they will get to this re-rating?
So this shift, the levels of consumption we're seeing aren't unprecedented. You could see that we've been at these levels before. Humans want to drink. Prohibition told us that. People won't stop. So that's part of it. I don't think we're structurally impaired. The other part of it is that the industry is consolidating. So you went from 4,000 active distillers to right now around 2,500. That's freeing up shelf space. That's reducing competition. The other part is Penelope's the main brand, but there's a couple of others. They're growing through a down market, so they're taking market share. It's easy to do great when the market's going up. It's very hard to do it when the market's declining. So I think consolidation is beneficial for them. The mix shifts. It's an easy path to margin expansion as they cut out these dead weight brands. The portfolio is broad. They have a lot of non-core vodkas, some Irish cream. They own Everclear. So as they cut out these dead weight brands, it frees up warehousing space, production line space, and the margin naturally expands. At some point, they have to be given credit for that. Yeah.